You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello, everyone. This is Brian Overby with Ally Invest. I am the options guy at Ally Invest and the author of the Options Playbook. And today we're going to look at a trade that we don't talk about very often. Inside the Options Playbook, there are over 40 different strategies, and we always try to come up with scenarios where this strategy might apply because of the pricing of the options. Everything we talk about on Options Playbook Radio is not meant to be a recommendation. We're just thinking about doing it on paper. It's supposed to be a learning experience. But one of the few things that we talk about are the most simplest trades, like buying a call outright, buying a put outright. We had a scenario last week where we looked at Boeing. Boeing's been an interesting stock that we've talked about quite a bit on Options Playbook Radio because Boeing has been in the news. And Boeing is a $340-some-odd stock at this point in time. And we've done a lot of long straddles in anticipation of the wild news events that were coming out. And so far, those paper trades, those learning trades have worked out. And so I want to talk a little bit about that Boeing long straddle since we put that trade on. And then I want to look at just buying options ahead of the Fed announcement. And important to note that if you are listening to Options Playbook Radio, we are taping Options Playbook Radio before the Fed announcement on Wednesday, October 30th. The markets are open right now. So we have Boeing. Let's go back to Boeing. Boeing has had a lot of news. The CEO of Boeing just testified in front of Congress. The stock, meaning to say, has been all over the place. And that's a good thing if you're buying option contracts, either if you're trying to pick a direction by just straight out buying a call or buying a put, or what we've talked about a lot on the Options Playbook Radio is just buying long straddles, buying a put and a call of the same strike price and the same expiration. So if I look at what we've talked about in Boeing over the last, 15 days or so, Boeing's been as high as 375 and as low as about 327 or 28. And so if I'm looking at a long straddle in Boeing, I just want to make sure that the stock has moved because of news events more than what I'm paying for that long straddle. And last week we looked at a long straddle. We were paying approximately $15 for that long straddle. And so we were looking for that type of movement. And one of the things that we wanted to do against it with that long straddle is we were selling some premium to help pay for it. So if you haven't sold that premium, in other words, you just bought the long straddle going further out in time, and you sold nothing against it in the short term, this is actually a great opportunity to jump back in and do it. And I would sell the premium on the side of the stock going up. So in our instance, over the last, since we put on that long straddle, the stock has now gone up as high as around 350. It's trading down a little bit today. We're going to call it 347. That's not exact, but we're just going to be rounding off. I would look to sell a call about 15 points higher. If you have not put on that trade, and this is one way to help bring in some premium, we went over a month in time when we were looking at the Boeing. Now what I would look to do is sell a call with about a week remaining to expiration that's about 15 points higher. And then if the stock runs up to there, well, you just close out that side, and then hopefully you get a move to the downside before your options expire. And that's just the way that you're going to manage this trade. Now, if you have sold some premium, well, that's a great thing. The stock is going up. It's going in one direction. The biggest thing that you want with a straddle is you want that movement to be based on the direction that you want. It doesn't help you very much if the stock is moving 5 or 6 points every day, but first day it moves up 5 points, next day it moves down 5 points, net, you're basically break even. But that's one of the things about Boeing is that this news comes out and the planes haven't flown yet. And we've mentioned this many times on Options Playbook Radio that if you're looking to do a long straddle, you don't want the news to be known. You don't want to do long straddles because there's an earnings, right? Because the options are going to be, it's a known event. You're going to have to pay a lot for those options. But a stock like Boeing, where you know news is coming, but you just don't know when, the planes could fly at any point in time, and that's definitely going to affect Boeing's. They had to testify in front of Congress. A bunch of news came out because of that. And the stock did move quite a bit around these people testifying. And on top of it, the fact that it's being talked about nonstop. All day long they were showing on CNBC the interview in front of Congress of the CEO, the questioning, if you will. So that said, that's Boeing. That's looking for volatility. We're trading Boeing because it's trading at a lower volatility than we anticipate. We think it should be trading for more. We're hoping for big swings in the stock. And so far, it's proven that over the last almost 6 months. Now, let's tone it down a little bit. Let's go back and talk about a strategy where we want to do this strategy because volatility has came in. We looked at a lot of butterflies, stuff that wanted vol to get smaller. We were looking at a lot of those type of trades. Why? Well, because the implied volatility on the market as a whole was up above the norm. It was trading at 18, 19% volatility in the VIX index, the VIX index. And today we have a Fed meeting announcement. And interesting enough, the market right now is down a couple of points in the S&P 500 index. The S&P 500 index right now, just to put a number with it, is trading at $3,035.21. It's down $1.68 at this second. The VIX index is trading at 13.04. And what's also interesting is that that's actually down. The Fed has not released their forecast for interest rates, and they've not said what they are going to do based off of this meeting yet. And yet we still see the VIX down about 16 cents. So we got the S&P 500 index down. We got the VIX down. That doesn't usually happen. I guess we could call the SPX more flat than down. Down $1.68 is pretty flat in the SPX. But here is an opportunity that if you want to buy options, I think it makes more sense. Now, once again, I don't necessarily have a forecast if they're going to do something, if the Fed's going to do something weird with interest rates. That's not what Options Playbook is about. We're just saying that in this type of environment, we have the VIX coming down towards the lows of the year, actually, down around 13%, not at the very lows, but much lower than it's been in the last 6 months. But yet we still have a known news event. So let's go on out And we're going to talk about, I'll let you pick the scenario where you want to go, but we're going to talk about buying options because honestly, we don't talk about it enough on Options Playbook Radio. It's a very popular strategy, but we're always looking at more advanced strategy just because that's what's inside the playbook, right? Most of the strategies have 2, 3, or 4 legs. So we're going to talk about just buying an option today because we don't mind where the volatilities are at. We don't mind the volatility. We know a big news event is coming out. So let's go into the SPYs. And the SPYs is an ETF, one of the most popular trading vehicles in the world. The symbol is SPY. It's considered the SPYTer S&P 500 ETF, exchange traded fund. The last trade on the SPYs was 306.98. That's down 23 cents on the day. It pretty much tracks the S&P 500 index. It's fairly close. It's not exact, but it is fairly close. It does a pretty good job of trying to track that index. So makes it simple to be able to buy some option contracts in. So our paper trades for this week, what we're going to look at on the call, well, we'll talk about the call side, but then we'll just kind of look at the put side in general. Because when you're buying options, you can pick if you want to be bearish and buy puts, or if you want to be bullish and buy calls. But the concept of a lot of people like to just buy out of the money option contracts. And when Mark Longo and I usually do our huddle ups, a lot of questions are based off of, well, what option contract should I be buying? And my answer is, well, first of all, if you're speculating and you think it's going to move to the upside, the best option to buy, if you are going to be correct, is an out-of-the-money option contract. Why? You get the most bang for your buck and you get the most leverage on that position. Now, the biggest thing, if you are buying out-of-the-money options, you need to make sure your forecast will make that in the money. So, for example, I'm looking at the December 20th expiration, the regular monthly expiration in the SPY. It's 51 days away. The stock, I'm just going to round up, is at $303. If my forecast is that I think after this Fed it can get to 307, and it could go up $4 based off of the news event that's coming on. If that's my forecast, I'm not saying that is, but if that's my forecast, I don't want to buy the 307 call, right? I don't want to look at that specific call option because that means that it's just getting there. I would rather buy the 305 or maybe even the 304 call because I need my option to pick up delta if my forecast is correct and it gets in the money. So I don't want to go on out and I think it could go to 307, so I'm going to buy the 307 call. That's okay if it gets there, but I want to give myself a little bit of a buffer when I'm looking at buying out of the money call options. So in this instance, I would probably look at buying the 305 with the stock at 303. We're 2 points higher in the S&P 500 index. Now, that would be 20 points in the SPX index overall. We all know that the SPX can move 20 points fairly easily. It was a decent-sized move, but it could move fairly easily 20 points. So we're going to look at buying the 305 call. Now, if we buy that outright, it's still fairly expensive. We're looking at 51 days to expiration. In this instance, that's $4.68. Now, a lot of people might say to you, well, Brian, why are you going so far out? That's still a $468 option contract. So here's my second rule of thumb. If you are buying out of the money options, I would rather err to the side of going too far out as opposed to erring to the side of going too short. And here's the reason why. Yes, I do have to pay a little bit more. If I'm just thinking of it just on a single option basis, I do have to buy more. I have to pay more, which means I do ultimately have more risk in the position. But as you go out of the money, you actually pick up deltas. So, for example, if I'm looking at this December 20 expiration, I am getting even 2 points out of the money. I'm still getting a 47-cent delta. So that means if the stock goes up 1, I would expect my option contract to go up by 47 cents. Now, if we go, let's cut the time in half. Let's go from 51 days down, and I have a that's a 26-day option contract. That's as close to in half as I can get. And I look at that 305 call. In this instance, I'm still paying a decent penny. I'm paying $2.75 for it, but my delta goes down to 41 cents. I lose basically 6 shares if you think of delta as a share, because you're buying every contract represents 100 shares. So you're getting 6 shares less as far as delta is concerned. If that stock goes up 1, this option contract would go up by 41 cents as opposed to 47 cents. All right. Then to go along with it, so I get a little bit more delta, I also get a slower rate of time decay. Time decay goes down. And I am worried about it on out of the money option contracts. So, if it makes the move, but it makes it after expiration, that just doesn't do me any good. And I can always get out of the option contract, especially if I'm trading something like the SPYs. They're extremely liquid option contracts. I can sell and close my position. So if I'm buying out of the money option contracts, the 2 rules of thumb are I want to make sure that my forecast it might be incorrect, but I just don't want to buy a stupid option thinking that it's going to go to 307, so I buy the 307 option contract and it just misses. I want to buy something that's going to be in the money if my forecast is correct, and I always err to the side of going further out in time. I get more delta, I get a little less theta. I do have some more susceptibility to implied volatility situations, but this is part of the reason why we're buying it right now with the VIX at 13, as opposed to doing this trade. I wouldn't even consider this trade if the VIX was at 18. I wouldn't even be looking at doing this type of trade ahead of the Fed. You're just paying too much premium, too much volatility premium for the options. All right. So the next step of this is, well, if I don't want to speculate as much, I don't want to buy the out-of-the-money option contracts and leverage my position. If I'm going a little bit in the money, I don't mind going shorter. And part of the reason why there is if I go in the money, I get delta anyways. I always want to pay attention to the amount of time premium that I'm buying. But the further you go in the money, the more expensive the option is, but the less time premium that you are paying for. So in this instance, since I'm really kind of doing it around the news event, I'm going to go with a 16-day option contract. I don't mind that position. You might think about a 30 just because you want the trade to work a little bit for you, but I'm going to go 16 days. So I'm going to go a little bit more in the money. I want to get some delta. So I'm looking for a delta of around between 70 and 80. And if I go to the 16-day option contract, the November 15 expiration, I can buy the 298 strike call option, once again with the stock at 303 approximately, and I'm paying $6.40 on the ask for that. So I'm paying $640 for it, but what I'm really paying attention to is if I look at the actual price of the put, that will tell me approximately the time value. Not exactly, but approximately good enough. And that's $1.38. So I am paying $1.38 of time premium, but I'm getting a lot of delta. My delta is 73 in this instance. That means if the stock goes up 1, my option contract is anticipated to go up by 73 cents at least. It would probably go up a little bit more because the delta is dynamic. Now, if I think about delta and in the money options, the exact opposite is true in that if I'm closer to expiration, my deltas would increase. All right, so 298 strike call. The market's still at 303 in the SPY. My delta is 73 according to the Ally Invest option chains. If I move out and I look at that long-term option that we're going to buy out of the money options on, and so in that instance, it's the December 51-day to expiration, the December 20th. And I look at that delta is now 65 cents, and that option is trading for $9.28. So I'm paying up for that option contract. And as far as the time premium is concerned, just by looking at the put, I'm seeing that's trading for $4.32. So I'm paying a lot more time, and I'm getting less delta. I know it's kind of counterintuitive, but then That's the way Delta works. So if I'm going in the money, I don't mind going a little bit shorter. I pick up Deltas. Once again, I lower my time value overall, so that kind of helps you out here. But my forecast has to be over that 60 days. I don't want to have that stock move after my expiration. That's still fairly important. But I get Delta by going shorter term on in-the-money options. I get Delta by going longer term on out-of-the-money options. And it's all based off of the concept that this is actually not the textbook definition of Delta, but a lot of the traders on the floor think of Deltas as probabilities. What's the probability of this option finishing 1 cent in the money on expiration? Well, if it's the probability of it finishing 1 cent in the money on expiration, and I'm already in the money, I would rather have a closer expiration, right? Because I'm in the money. If it's going to finish at least 1 cent, it's not saying you're going to make money. It's just saying I'd rather have less time for it to get out of the money. And the opposite is true on out of the money options, right? If I am out of the money, I need it to get in the money, and time is my friend. Over time, I have a better chance that it will get in the money. And that's really where deltas come from. And if you just pick up that one little concept, it helps a lot in your thought process as far as buying in, at, or out of the money call options. All right. So now, with that said, I mentioned that if you want to be bearish, you could go on the put side. I would basically stick with the same type of deltas. We looked at the 305 call on the upside, and that had a delta of 47. So if I'm going to go down on the put side, I'm going to look at doing about the 302. That has a delta fairly close to 47. Also, that's 1 point out of the money as opposed to 2 points. But there's a skewing in the calls, and that kind of or in the puts, I'm sorry, as far as volatility is concerned. So I'd look at the 302s. And then if I'm going in and I'm trying to be bearish on the November 15th expiration, we said the delta was 73 on our 298 strike call. So on our put, to stay somewhere similar in regards to delta, we would look at the 307 strike put. That has a delta of 74 in this instance. All right. So an opportunity to talk about buying puts and buying calls, mainly because, once again, the VIX is lower than it's been in a while. We have a known news event, so it's kind of odd that the VIX is down to this level. The market is down a little bit, and the VIX is down a little bit, even though the Fed hasn't came out and announced what they plan to do with interest rates. So, once again, we're taping on Wednesday, October 30th. The market is open. The Fed has not announced. And that's going to be it for this episode of Options Playbook Radio. I'm Brian Overby, known as the Options Guy here at Ally Invest. You can email me at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.